I'm talking markets with Jim Bianco, president and macro strategist at Bianco Research. Hey, Trim, it's great to have you back on.
Thanks for having me. Quite a week we're finishing up with.
Wow, and it is action packed right up into the end, isn't it? We saw a little bit of a whipsaw session for U.S. stocks. We had a busy day to begin with. We had some mixed economic data. Everyone's still digesting, of course, Nvidia earnings and taking a look at this market. And then, wow, fireworks at the White House. Very public clash between Trump and Zelensky, which seemed to impact stocks temporarily. And then we saw them uh, drift back, so they're ending up, and it looks like a little like pretty, a lot of that buying coming pretty late in the day. But it's been a rough week. Investors seem unnerved. Should they be?
Yeah, sort of. But I'll just say before I jump into that, if you haven't seen the video of the clash at the White House, you never see that in front of the public cameras, and
Ever?
it's worth watching. Whatever side of the aisle you're on, it's unlike anything you've ever seen before in politics.
Yeah.
But yeah, I think the problem with investors right now is they're getting very worried. The data on sentiment, if you take like the CNN Fear Greed Index or some of the other things, is it's where we would be in the ninth month, 25% off the high. We're 9 days off the high, and we haven't even done a 4% correction. And if you actually look at the S&P since the mid-November, right after the election, it's been in a channel. It's been in a sideways market. 9 days ago, we made the all-time high. It was a marginal all-time high, barely above that channel. Now we're in the middle of it. And yet, all we've got now is people openly screaming about recession and terrible things happening and everything else. And I don't think it's justified at this point. Now, maybe the data keeps weakening, maybe things get worse, but let's talk about what's gotten worse in the last 2 weeks. There's been no real hard data, actual economic data that's gotten worse. There's been a bunch of surveys that have gotten lousy. And what have we learned about surveys? They're highly partisan. And what's happened in the last 2 months with the surveys is all the Republicans have gotten optimistic, and all the Democrats in the surveys now think we're going to rerun the Great Depression. And the Democrats are dragging it down more than the Republicans are boosting it up. That's very clear in the University of Michigan surveys and some of the other surveys. So, is that really what we're doing here? We're basically deciding that we're selling stocks because, newsflash, Democrats don't like Donald Trump. I mean, that's essentially what we're arguing. And that's why I think we're kind of overdoing it right now. That
That's
the
so
data
interesting. So
is,
you think that it is just the sort of political division playing out in these surveys?
yes, I think all these surveys, all of them, whether you're talking about consumer confidence on down the line, I'd even go as far to say in the investor surveys, whether you look at AAII or something else, their political division, partisanship drives these surveys. That's why, every so often I keep coming back to a piece I wrote in 2012 uh, that I called, economic survey, consumer confidence surveys and economic surveys, the world's most useless statistics, because all they do is they tell me who you voted for. They don't really add much value to the economy. Hard data, like payrolls and retail sales and earnings, that has a lot of value. But this ephemeris kind of, how do you feel about things? What's your outlook? A lot of people are now voting on those based on the election. Trump is a divisive figure. Trump is an emotional figure either way. And it is, I think, showing up more in these surveys than it would have, say, under a more reserved president.
I feel like there isn't an adjective that we can find that doesn't seem like an understatement, especially as we talk today. But um, I'm interested in that though. Okay, so as an indication of what's really going on, but can these things sort of lead and become something that we have to pay attention to? We know consumers are a huge part of the economy. Clearly, people feel uncomfortable, even if it's along party lines. If you are right about that, we saw this sort of economic boycott floated around today. I think it was more of a social media thing than anything else. I don't know how many people actually participated, but it was a lot more prevalent than anyone thought it was. If people feel uncertain, if they don't know what's going to happen with tariffs, if they're afraid about egg prices, regardless of who they blame, can that not turn into people just getting more risk averse and cautious and become an economic phenomenon?
That's exactly how it works, and it's unclear whether or not that would be the case this point. I'll come back to a statement I always like to make, right? That the natural for an economy to do is to expand. It's somewhere, I'll use GDP numbers just to keep it simple, somewhere between 2 and 2.5%. That would be like normal if no one's trying to stimulate the economy or restrain it. It'll grow 2.5%. If you leave the economy alone, it will do that over long periods of time. Now, there'll be periods where it'll grow a little bit less. There'll be periods where it grows a little bit more, but it will always grow. In 90% of the years since World War II were not recessions. The other 10% are recessions. What causes a recession? An economic murder. There was an economist, Rudy Dornbush, in the 1970s at MIT, said economic expansions don't die of old age, they're murdered. And a murder is a COVID shutdown. It's a war. It's 9/11. It's an Arab oil embargo. It's those kind of events that come along and they cause people to change behavior. Now, let me say this about an economic expansion. All your guests, including me, can't predict one
Mm.
because they're not in the economic or the financial data. It's not looking hard enough in the earnings data and you'll see a recession coming. You don't. It's not looking hard enough in the economic data and peeling back the unemployment report. You see a recession. You don't. A recession is, as I like to put, a red headline comes across the screen. You go, holy shit, I got to change my behavior
Mm.
because of what's happening. Now, is that what's happening now? Are people looking at this economic data going, I don't care what the economy's doing. I'm just going to stop doing what I'm doing. If that's what they're doing, first of all, I'd argue none of your guests, including me, can tell that that's happening. It
Right.
will just happen and it will show up after the fact.
Hmm.
The stock market will be down 15%, and then it'll be very obvious to us that that's happening. So I don't know if that's happening. I would guess it's not happening right now. But you're right. As of tonight, I would say there's very little evidence that that's happening because the data has not supported it. The stock market 4% sell off has not supported it. Now, we have another 5% or 6% down in the next 2 weeks. Then, yeah, that might be evolving. But this is the hard part. If there's people screaming at me, well, of course we're doing it. You're guessing.
Yeah.
And I'll tell you what, I'm guessing that we're not having it. You can't see that. You don't know what's in everybody's hearts and minds that they're thinking, maybe I won't buy that car. Maybe we will change our behavior. Maybe I should move my investments to something more conservative like a money market fund and get 4%. You don't know that they're doing that in their hearts until after it's happened. And that's the real question. Is what's happening with tariffs, with all the histrionics that come out of Washington, with all of the talk about geopolitical things and all the worries, are people looking around going, I should change my behavior? If the answer is yes, and they're getting more defensive, then yeah, there's a worry about a recession. But let me emphasize again, you could bring on the smartest economists and they're going to peel back the unemployment report and the retail sales report. You could bring on the smartest analysts and they'll dig down to the nth degree to tell you where every H100 chip went with the Nvidia sales. They cannot see a recession in that data because it's outside of that. It is a change of behavior that's not dictated by the data.
Yeah, that's very important and very honest because there's a lot of people who make a living acting like they can call these things, and it's not. But it's a deep look at what contributes to it.
Yeah, and to be fair to them, you can peel back the data and say, I see weakness.
Hmm.
And I think that we're going to see 1% growth to keep with the GDP number, or we're going to see a miss on earnings. Yes, you absolutely can if you're a good analyst. But you peeling back the data going, man, we're going to fall apart and we're going to have a recession and a 25% correction in the stock market. That you can't see. That is a change of behavior. That's why the phrase economic expansions don't die of old age. They're murdered. You need a murder weapon. Obviously, we know the last murder weapon was a global shutdown following a pandemic. Now, whether or not we're having a murder weapon here, and just to give people an idea, the last instance I thought we might have a murder weapon to have a recession was the Silicon Valley Bank failure. And
Mm.
then you had Republic Bank, and you had Silvergate and Signature, and then you had Credit Suisse. It's like, wow, we're going to have a financial crisis. Well, guess what? We didn't. But that's the type of thing that people would look at and go, uh-oh, maybe cancel the plans to buy a new car, or we've been looking for a new house. Maybe we'll just sit tight for a while and see what happens. And that's how you wind up having a contraction in the economy. So yes, those analysts can say we're going to grow below trend, and absolutely they can. But we're talking about the worst case scenario, a contraction, a big correction in the stock market. That needs some kind of psychological change of behavior.
Yeah, yeah, excellent, excellent point. And everyone's, I think, kind of thinking along the same lines here when you're looking for a murder weapon. Uh, uh, Jared is giving voice to it, but there's a few in the chat who are asking this. Hi, everybody, by the way, happy Friday. Uh, and he's saying, murder weapon, DOGE and layoffs. Couple people asking about layoffs and the impact on the economy. I'll throw in DeepSeek to that as well and the impact that had on sentiment surrounding the AI revolution. Do either of those seem like they could be the type of thing that will shift sentiment enough to you right now?
Sure, but here's the problem with Doge. How significant is Doge? Because if I read the New York Times, they keep insisting that it's marginal, that there's not a whole lot going on there. But if
It's
I
because it's
listen to
tied up in the
Elon,
courts probably, right?
right, that and that they're overstating the cost savings
Mm,
is what they're doing, and that they're not really the cutbacks are not really that big. If I listen to Elon, it's epic. It's monumental what's going on. So trying to figure out where that is in terms of government spending cuts is hard to say. Layoffs, it's possible that the layoffs could do it, but keep in mind, no one is going without a paycheck until September, right? Even though they keep announcing these people are getting fired and stuff like that, they're all getting at least 6 months' pay. So there's going to be nobody out without a paycheck. Now, you could see in some of the data, like the initial claims, I just tweeted this out right before we talked, the
mm.
initial claims for District of Columbia is soaring, but not anywhere else in the country right now. It's all around government jobs that are soaring. Could that be the problem? It is, it's possible, but I would argue that on the flip side of that, this is what the administration says, is that we're going to take bloated, inefficient jobs in the government and get rid of them with the regulations that they implement and replace that with more efficient, high octane private sector jobs. And that at the end of the day, we'll be better off. I understand the argument, it makes sense. Whether that's actually what happens is an open question. So when you think about, well, they're laying people off and they're cutting back government spending, and that's a reduction of economic activity, are they releasing animal spirits among, and not the stock market, not
Mhm.
investors, but among business people? Because remember, there's 3 million companies in this country that are not traded on an exchange. Bianco Research is not traded on an exchange. My company. Are they going to take, and I'm in the financial services business, am I going to see the FINRA and SEC and NASDAQ rules that are strangling my business or anybody's business that's in financial services being relieved and saying, wow, now that they're relieving us of this and giving us more opportunities, we're going to expand, maybe hire somebody else, maybe get into a new line of business or
Mm.
something like that. Write that times 3 million. If you do that, then these reduction of government jobs is not a problem. If you just reduce the jobs, but nothing else changes, then it is a drag on the economy.
Yeah. Another J&J also asks, on this murder weapon idea, what about falling asset prices themselves? So we're talking about consumer confidences and confidence rather and how consumers feel. What about investors? Because I would argue that like that nervousness has been around since we saw those big games while we've been at the highs. We constantly have people asking, should I get out? Should I get out of Nvidia? Is the Mag 7 over? because everyone's so overexposed to those. I don't want to say overexposed, but has such a high concentration in their portfolio. Everyone's holding them probably in some shape or form. What about investor sentiment? Why do you think that is so much on the fear side of the index?
Yeah, that's a good point about, what asset prices. Asset prices can do it, but usually asset prices need a catalyst. About the closest example you have of pure asset price decline is probably the 87 stock market crash. There was no trigger from foreign activity or from the economy. But even that one had a structural problem. I'm going to date myself. If you remember portfolio insurance with the advent of stock index futures, and that we misjudged how to properly evaluate and use that tool. And it's turned into a self feeding process and it crashed the stock market.
Mm.
Um, so even that one had a catalyst. So if the question is, will the stock market arbitrarily fall 20% because people are afraid? That's kind of hard. You'll need something more tangible than them being afraid. Now, the flip side of that is, will the stock market have a hard time rallying from here? Remembering it was 9 days ago, it was last week, Wednesday, that we were at the all time high. The market capitalization of the S&P 500 was $50 trillion. So, you know, we don't need, three buy recommendations. We need hundreds of billions of dollars to move the needle on the market. We need a lot of money to keep sucking into these markets to keep them moving higher. And maybe that's really where we're at, even though we've got passive investing and we've got the automatic flows in the 401ks and stuff. Maybe when you get to $50 trillion and the market cap to GDP of the United States is 200%, that the stock market is twice the size of GDP, that you need such a huge flow of money to just move that needle one tick, that we just don't have it anymore unless you're going to start saying everybody out of crypto, everybody out of bonds, everybody out of cash, everybody's got to get in Nvidia, because we can't have a money market industry and a bond funds, and we can't have crypto and have Nvidia keep going up and the Mag 7 and the S&P 500, because there's only so much money to go around. That could almost be kind of some of the argument. We then all try to augment that with leverage, right? We try to borrow, we leverage, but then that brings in its own host of problems too, because then you have people on margin and you could wind up forcing them out and creating more volatility.
And
So
that
maybe what I'm trying to
something we
say is,
always worry about.
right, what I'm trying to say is when you get to the all-time high at $50 trillion, maybe it's just such a big push to keep going up from here that it's going to be hard to go forward. Now, does that mean we'll never go up? No. The economy will keep expanding. It's a $30 trillion economy. In a couple of years, it'll be 32 and then 35. Earnings will keep going up. Companies will be making more and more money. And that money within the economy, based on $50 trillion economy, stock market, will eventually bring that market cap to GDP ratio down. And then the amount of money you need to push the market up even more will be found in the real economy. So let me finish this up by saying I've been one that, I'm not worried about this sell off turning into something ugly. But let me give you the upside, or the opposite, the flip side of it. I've been arguing since late last year that I think the 20% runs in the stock market are over. And that I think over the next several years, I've called it the 4-5-6 market. Cash is going to return you 4, bonds are going to return you 5, and stocks are going to return you 6. So they're going to barely beat bonds is what they're going to do. Now, I would argue that's a pretty positive story. Why? I like it when the stock market when S&P goes up 20% as opposed to 6, because with a 6% continuous return, maybe some years you have 12, some years you have 0 or something like that. Or you have 18 minus 6, and you kind of average out to around 6% or something like that. With that kind of return, what you should see is the return of alpha in the market. Now, that's a fancy word. What that means is we all buy indexes because no one can beat the index. Well, no one can beat the index when that beta tailwind is just pushing the whole index up 20%. For me to then spend some time looking at energy stocks versus healthcare versus Mag 7 versus international stocks, why bother? Just own the index. It goes up a lot. Now that the index is going up 6% a year, there's going to be a lot of opportunities to make a lot more than 6% a year. but it's going to be back to like the old Peter Lynch 90s era, right?
Right. You've got to be in
Picking
the right
stocks,
stock.
picking theories, picking stocks, picking sectors, picking themes, so you've already heard one theme that's coming along. People are saying the European stocks are beat up. Their forward P's are in the 10-12 range. The US's forward P's are in the 22 to 25 range. Maybe we should be rotating into, European stocks. That's the type of market we might be returning back to. And I don't think that's a bad idea. Capitalism is about taking money away from bad ideas and giving it to good ideas. Passive investing is everybody gets money, whether you mismanage your company or you don't mismanage your company. If you're in the index, you're always getting money. Maybe if we get back to capitalism, that would be a good thing. 6% return in the index is not such a bad thing because there'll be much better opportunities for 6% in some other ideas. But we're going to have to shift our thinking here. Instead of demanding that the broad indexes just do all the heavy lifting for us and go up a lot every year.
So, what you say makes sense to see that sort of rotation to other sectors, to individual stocks, or managers who are picking them, or to more diversified cash, bonds, and stocks, as opposed to everyone being so levered up on stocks, or allocated to stocks. But to do that in an orderly way means everyone would proactively make the decision before anything bad happened. I can imagine there are people who are sitting there with a lot of Mag 7, a lot of Nvidia, big gains in them, and then if that thing starts to go and people sell their winners to rotate like you're talking about, um, does that look like a rotation, Jim, or does the whole market get pulled down? Because it will feel like a mini crash to people who are sitting with that high concentration in their individual portfolio.
Right. And to first part is that if you own VOO, IVV, or SPY, those are the three big S&P 500 indexes. You're exposed to the Mag 7 because they're 30% of your holdings, and that isn't so they're almost a third of what you hold are those seven stocks if you buy the indexes, and those are what's really been holding the market down. But you're absolutely right. In that process, it's not an orderly process to get out and go into other things, go into other thematic ideas and themes and stuff like that. Uh, but what it does is kind of what we've been seeing. A lot of volatility with very little gain. It doesn't mean the market has to go down because money's not leaving. It's just being shifted around. And the
Well,
other thing I would say too,
it's leaving Nvidia.
right,
So, but if you're in it in an S&P index, but if you're in it in a sort of mega cap tech ETF, you're gonna feel it, right?
right. If you're in the triple Qs,
Yeah.
you're definitely going to feel it. Yes. And that is part of the rotation because the rotation by its nature means there's going to be winners and losers. And what you want, there's going to be stocks that are going to do much better than 6%. And there's going to be stocks that are going to do worse than 6%. And it's going to average 6. So you might be stuck in a triple Q. And that might be one of the losers, And there might be energy stocks or European stocks or maybe financials that will actually wind up doing better. But you've been so locked into this whole idea about technology and AI, financials. Why would I bother with that? I mean, buy JP Morgan? Are you kidding me? No, actually, look at what they've been doing. They've been actually doing very well. Europe is a museum. It's not an investable thing, right? No, go look at what their stock market has been doing. It's been doing very well. And so you started thinking that way. And the final thing I'll bring up to you, what's also happening in the ETF space is what about giving your money to a professional manager? Professional managers are now racing to ETFs to put up actively managed ETFs. So it's not about, oh, do I have to go back to an old line mutual fund and hand it to, some star manager? Look, the trailblazer in equities, maybe not the trailblazer, but the person who popularized actively management in equities is Kathy Wood. And there's a lot more people that are doing it, not only actively in stocks, but actively in bonds. And full disclosure, I have an active fund in bonds and WTBN as well. And so if you're thinking about the idea that we could return to a period like I'm old enough to remember the early 90s. And in the early 90s, there was a moment there when we weren't talking about stocks, we were talking about star managers. Give it
Yes,
to Peter
I mean,
Lynch.
exactly. That's what we all used to be
We all grew up
aware of.
talking about the
Right,
portfolio managers.
right. Who
Look
were
at Peter
doing
Lynch
due
or
diligence on their
Gary Brinchin. George Vanderhitten. If you don't know these names, these were guys in the late 80s, early 90s that, Ron Barron, just some other names. I'm blanking at some of the other names.
Oh yeah,
We talked about them like we talk about companies today. And maybe if we could get back to that within an ETF structure. They're all just moving towards doing that in ETFs. So it's just another ticker symbol for you to take a look at
yeah, which is
as
going to be
well.
really important. Let's whip through a couple more things while we can. But this is a really important conversation, and the takeaway should be proactive at looking at
Right.
your portfolio right now, because right now might be a good time to make sure you fully understand what your exposure is to the Mag 7, including going into the details of the holdings of all the ETFs that you might have. I know a lot of you are super smart and trade your own stuff, so you're already way ahead. But if you haven't kind of plugged back in, this would be the time to do that. What about bonds? We had someone ask about bonds, and the direction of bonds. Bonds have been rallying.
Yes, bonds
Why?
have
What does
been
that tell
rel
us? And is it gonna continue?
Yeah. So what the normal saw that people have about bonds is yields going down, either inflation is falling or the economy is weakening. Yields going up, we have an inflation problem or the economy is strengthening. That is right about 80% of the time. But there's another 20% of the time where yields are going up or down, and there's another reason that was never on the typical radar screen. I think we're in one of those periods now. What has changed in the last 2 or 3 weeks in the bond market that's got yields down 30 or 40 basis points from its peak? And I would argue it's this whole thing I've been talking about called the Mar-a-Lago Accord. And really, what this is about is an effort to lower the dollar. It's got three steps: tariffs, which is we all know about; the sovereign wealth fund, which is the idea of boosting the assets of the United States to make the debt pile look, the $36 trillion of debt look a little smaller relative to the total assets of the United States. And the third part is what I wanted to focus on: payment for security. Now, 2 or 3 weeks ago, no one knew what payment for security meant.
Hmm.
But now we all understand that Trump has been hammering away at Europe for 80 years. The United States military has provided security for the world, for the trade routes against communism and then against terrorism. A big chunk of that $36 trillion of debt has been defense spending on behalf of the United States. As a percent of GDP, the United States spends way more than the other NATO countries. And Trump said, you got to start paying more. And guess what they said? You're right. We're going to start paying more. Germany's talking about increasing their defense budget by $200 billion. Germany has a debt break. You and I in the United States might know that as something like a balanced budget amendment, that they can't deficit borrow. They're talking about removing it so they can deficit borrow to expand defense. So the UK has said they're going to up their defense spending to 2.5%, then to 3% of GDP. So all of a sudden, and Europe is, by the way, Europe is talking about a federated army, right? I just want to say they're not going to have a German army and a Spanish army and a French army and an Italian army. They're going to have one European federated military or defense force. We have 60,000 troops in the American troops in Europe. Maybe we could go down to 40 or 20. All of a sudden, we're starting to look around going, wow, that could be big savings for the deficit, because we could spend less because Europe is going to take on that burden for us. And now we're talking about, reduced supply and stuff. Now, keep in mind, markets are forward looking, because people say, but they just put up a budget and it has nothing of that in there. Markets are not worried about what they put up in the budget. Markets are thinking further down the road. If this does unfold, that we're going to see them step up. Europe, to put a number on it, Europe has said they're willing to spend $3 trillion on defense over the next decade. Okay, we won't spend 3 trillion less, but maybe we spend 2 less. That's $200 billion a year. That's 10% of the deficit right there, for opening shot a month into Trump's term.
Mm.
And so that could be one of the things I think that's been powering this market down. Now, there's a risk. And there's two risks. One risk is that it's all talk and it doesn't happen. That's always a risk with politicians. The second risk is, I'll riff on this real quick on the bond market. It's what Speaker Johnson said about DOGE when Elon threw out the idea, we're going to save so much money, we're going to send everybody a $5,000 check. I have no idea if that's going to happen. But what Speaker Johnson said was, well, why don't we pay down the nation's credit card first before we start sending out people money? In other words, pay down the debt. I'll use one of my kids, and I'm going to get in trouble when she hears about this. is an adult who's got a credit card who's at its limit and keeps asking mom and dad for some money to get her credit card down off the limit. And we've done that a couple of times. And then guess what happens? Go, oh, now I've got spending power. It goes right back to the limit. And so that's what I'm worried about when Speaker Johnson says, oh, well, let's take whatever savings we get from defense payments, security payments, or DOGE, and let's pay down the debt. So Congressman could go, oh, now we have room for my favorite project. Now we have room for that thing that my biggest donor in my district
Well, we're
wants.
also we're also not taking into account that no one made this pact with the American people saying, "Give us 5 years of austerity and we'll balance the budget." That was not what the election was about. The election was about,
Right.
"You can have everything." That's what every election, that's not a political statement. That's just no
Yeah.
voter
No,
votes for
you're
austerity.
right. You're right. So so one of two things, maybe three. One is all these promises don't pass. Thing two is if they actually worked and they brought down some of the spending, if it does require austerity, people would then demand, okay, now you've got room, spend again. Oh well, then we didn't really accomplish anything.
Right.
But if we did bring down the spending, found a way for future presidents and future Congresses not to spend. Again, their hope is bringing down regulation, unshackling those 3 million private sector businesses to get the growth going, that there wouldn't be austerity. In theory, that's not wrong. In reality, it's hard to execute that
It's hard. The
without it being
sequence
disruptive.
matters, right? The time between the actions is gonna matter a lot.
Right.
I don't wanna take up too much more of your time, but let's just squeeze in. People are asking, some people think this fear that we're seeing and selling is a buying opportunity, including some, best, YouTube comment said right away that he's been busy buying. So, it sounds like you do not think that a decline is necessarily a straight out buying opportunity. You have to be pickier. And if that is true, you can tell me if that's true. And if it is true, what do you like here, Jim? What would be a haven to the volatility, somewhere that you can go? And if you don't have a high tolerance for risk because things are so volatile, like what feels like the right place to park if that's your profile?
So the argument about it being a buying opportunity, I would agree on the short term because too many people are pessimistic. The problem is I only see you probably buying for 4, 5, or 6% gain. There's not going to be an 8, 10, or I'm talking about index level, not going to be 8, 10, or 15% gain. Because I think if you want to buy for those bigger gains, you've got to look at rotation and you've got to look at European stocks, financial stocks, maybe some energy stocks, thinking about those type of thematic kind of ideas, gold stocks. You've got to start thinking that way. But if the answer is everybody's bearish and I'm going to buy VU, which is the Vanguard S&P 500, which is the largest ETF in the world, okay, fine, but don't expect 6,500 or 7,000 on the S&P. I just don't see that being in the cards. We're given the high valuations that we're already starting with. If you're kind of worried about this, where do you go? 4, 5, 6 market. I would argue that 5 or 4 would be a good place to go. What are you getting out of the? What are you getting in a money market fund? 2/3 of what the S&P is going to give you with a $1 NAV, zero volatility every day. What about the bond market? Actually, fixed income bond market is actually the best performer of, if you look at crypto, stocks, bonds, cash, number one is the bond market right now this year. That could potentially give you 5-ish% in a 6% world with a little bit more volatility, but not tremendous volatility. Last year was a bad year in the bond market. It was up 1%. That's what a bad year is now in the bond market.
Yeah,
Is
so
up
less risky.
1%.
What
Yeah.
about what's happening in crypto? We see a lot of people sentiment there after that big backup. Buying opportunity?
No, I don't think it is. I think what's happening is if you go back and you look at where did crypto peak, it peaked the weekend of the inauguration. What happened the weekend of the inauguration was Trump rolled out his meme coin. What is getting crushed in the crypto market right now is Solana. Why would I point up Solana? All of the meme coins are on Solana's blockchain. Trump's coin, Fart coin, Melania's coin, the Libra coin, all these things that we keep talking about, they're on the Solana blockchain. What is getting annihilated right now is Solana. I think Trump's meme coin put the mania peak in the meme coin in meme
Mm.
coins, and now we're deflating meme coins. Dust off NFTs from 2022 when we were all talking about bored apes and everything else, and everybody's paying outrageous prices on OpenSea and Rarible for all of these NFTs. Where are we 3 years later with NFTs? It's effectively a dead market. There's no bids on this stuff. They're all gone. I think that that's where we're going with these meme coins. I think the meme coin mania is done, and it's going to deflate into obscurity. The biggest loser in that is going to be the home of all the meme coins, which is Solana, and it's already down 57% in a month. By the way, there's 7 million meme coins. We create thousands of them every day because it takes you less than a minute to create a meme coin. 99% of them never ever trade. But the point about meme coins is create a meme coin with a funny picture of a frog and a good story, and then pump the hell out of it on Twitter, and hope that somebody takes interest in it and starts buying it and bids it up, and then you take what you call your founder's stash and you sell it into the market and you walk away to profit. Um, that's a scam, and that scam I think is unfolding. It's going to drag down Solana, and it's going to hurt the rest of the crypto space.
Mm,
Now, I don't think Bitcoin is going to get smashed as hard as the rest of them because it's not part of it, but it's not going to buck the trend. You're going to just lose less money, I think, is what's going to happen. So, yeah, Bitcoin could trade down. It already went under 80,000 earlier today. It could probably trade into the 70s, maybe even into the 60s, but it could stay there for a while. But I think as we deflate this, and the last thing I'll say about this is not new. We saw the ICO, the initial coin offering boom, do this to all of crypto in 2017. We saw the DeFi boom do this to all of crypto in 2020 when we overdid the DeFi boom. We saw, as I mentioned, the NFT boom in 2022, and now we're seeing it with meme coins in 2025. So this is the fourth cycle of what we've seen with this.
yeah.
So it's going to take some time. It may not take devastating losses in Bitcoin, but it's going to take losses, and it ain't going to be there's not going to be a whole lot of gains at this point. And so I think we all looked on inauguration weekend. Trump rolled out his coin, and we all talked that within 36 hours, his founders' holdings was worth $50 billion. And we were astounded by that. Now his founders' holdings are worth way less than $1 billion, and they're probably on their way to zero. And in the meantime, it put the speculative peak in the market.
Mm.
You look at all these coins, they all peaked somewhere around the 20th, 21st, 22nd of January, right when we were all going crazy about the Trump coin. So it was more significant than we thought it was initially.
Yeah. We have so much to get through. We had a question from Christopher about Atlanta Fed. Now, I know you tweeted extensively about that, Jim, so I'll just refer people to your Twitter. Everyone remembers that you were hard landing. You just said how it's difficult right
No
now.
landing. I was a no lander.
Sorry, no landing. Yeah, 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 no
Yeah.
landing. Excuse me. Um, and so, do you have a sense of where we are now? Someone asked, hard landing, no landing, soft landing, or are we
I'm
kind of
still
in
in
the
the no
fog?
landing camp. For those that don't understand these terminology, it just means the economy is going to grow at its potential. It's going to be okay. Now, what I do think is happening with the economy is economists have this term called the K-shaped economy, where the bottom half of income does, on a relative basis, worse than the top half of income. And it really comes down to inflation and asset prices. That the top half of income, they see the price of eggs going up, but they also own a home and they have a portfolio that's going up, and they go, I hate the price of eggs, but I can afford it, and they buy them. The bottom half of income rents, doesn't have a portfolio, and they see the price of eggs go up, and they go, I can't buy it. And so the bottom half of income has always been kind of in that struggle. And that was what drove the election, the anger about inflation
Mm,
and everything else. The top half of income saw the same things, but was fine because Zillow sold them, their house was going up, and their ETFs were going up in price. But if that moderates now, then I think that we could wind up seeing that no landing kind of become kind of a low landing. I'm not ready to go to the soft landing or the hard landing. Hard landing is a recession. That's a murder weapon. That's what that is. So I'm still in this idea that at the top line, the economy will do okay. But where you might see the weakness, you could see the weakness is in the top half of income getting a little bit nervous. The
Mm.
bottom half of income, I don't know how they could get any more nervous. They can't buy eggs. They don't have a portfolio. They don't have a home. They rent. So what are we going to do to scare them anymore? It's the top half that has a home and has a portfolio and stuff like that that tolerates the price of eggs. But if those start to change, then you might see them start to change. For now, I'll still stick in the no landing camp, and I'm just trying to lay out some of the things I'm looking at.
Amazing, and gave us a lot to pay attention to and to put on our radar as well. Jim, it's always a pleasure to catch up with you.
Same with you, Maggie.
Thank you so much. Have a terrific weekend. Thanks for all the great questions, everyone. Have a great weekend. We're gonna do a write up of this as we always do on Substack, so you can go to Substack. Maggie Lake, I think it's substack.com, Maggie Lake, and find it there. We'll post it as soon as we can. Have a wonderful one, everyone. Take care and good luck out there.